Welcome back. In this session, we take a look at capital budgeting and the process of allocating capital within organizations. The specific topics we're going to take a look at in this series of videos includes an overview of capital budgeting, or the process of capital budgeting. We'll take a look at some of the main methods that are used, including net present value, internal rate of return, the modified internal rate of return, and a couple of specialized methods that are used in certain circumstances, including profitability index, payback period, and the discounted payback period. But before we go into the methods, we should consider what capital budgeting is and the importance of capital budgeting within the organization. Essentially, capital budgeting is the process of planning and management of capital spending within a company. And in particular, we're looking at long-lived assets, assets that are going to be part of the long-term capabilities of the organization. And this includes things like buying new machinery, establishing new plants, expanding to new locations and new markets, even the acquisition of competitor firms. So it's about the future of the organization. And being good at capital budgeting means not only that you're a capable technocrat who's able to understand how to price capital and how to move capital within the organization, but it's also about power. It's about the organization's future. Whoever controls the capital budget controls the future of the organization. It starts off with the analysis of potential prospective projects, prospective acquisitions, new markets, new businesses. It's typically long-term. It expands beyond 1 year, but perhaps well into the future. Capital budgeting is a difficult process, and for that reason we tend to use the capital budgeting process only for major projects, for large commitments of capital. And really, it is about the future. If you're a successful manager, if you intend to be a successful manager, it's because you're capable to influence your colleagues to invest in the projects that you're behind. If you are very good at finding new projects but don't understand the capital budgeting process, clearly you have a disadvantage within the organization. The steps in capital budgeting start off with forecasting, estimating the cash flow within the organization that will result as a result of the new project's implementation. The inflows and, of course, the original capital expenditure, the major outflow. You need to be able to determine what the riskiness of those new cash flows is going to be, and of course be able to estimate the weighted average cost of capital, the discount rate for that particular project. With this information, we can then evaluate the cash flows to determine what the net present value or the effective rate of return is going to be on that particular project. Before we get into the steps and the calculation, there are a couple of other things that we need to think about. One of those is the nature of the project itself. Some projects are by their nature independent, and that means that they don't affect the investment in other projects. Independent projects are projects where the cash flow of one particular project is unaffected by the acceptance of other projects. Essentially a standalone project. Mutually exclusive, on the other hand, means that if we go ahead with this particular project, we will no longer be able to do other projects. And that may be because those projects have got resources which are necessarily going to be exclusive. Perhaps a piece of land that will be dedicated to a new project, if it's used for that project, can't also be used for a second project. So understanding the difference of this is going to be important in the decision process that we'll talk about later. Remember from our earlier discussion that the determination of value in a project is going to depend on three fundamental things. There's the return from the project, the risk from the project, and the third item that we need to think about is the timing. And for that reason, we look at timelines for the cash flow. In the first example, Project L, we have got 4 cash flows. We have an original cash flow out, the original investment of $100 million. In year 1, we have a cash inflow of $10 million. Year 2, we have a cash inflow of $60 million. And year 3, we've got a cash flow of $80 million. If you think about the net of the cash outflows plus the cash inflows, we have minus 100, plus 10, plus 60, plus 80. Or the total amount of cash flows would be $150 million cash received and $100 million of cash spent. So a net of $50 million. That's the largest possible cash flow we could receive from this project. But of course, don't forget that in this project we have got risk, and we're going to be able to calculate the effect of the opportunity cost of capital, or the discount rate, to calculate the net present value. So for example, in a project like this, the $100 million that we have is essentially $100 million in today's money. So that's worth $100 million, and it's a negative value. The $10 million that we're going to receive in 1 year's time has to be discounted at 1 plus the discount rate. And the discount rate in this case is 10%. Then the next cash flow we're going to receive is $60 million in 2 years' time. And that's going to be discounted by 1 plus the discount rate squared. And then the third cash flow is going to be $80 million. And that's going to be discounted at 1 plus the discount rate to the third power, because we're going to be waiting for the money for 3 years, the effect of the compounding, and so on. So the later cash flows are going to be significantly less valuable than the cash flows at time 0. If we're comparing that to another project, for example, Project S, which has got the same cost, it also costs $100 million, but the cash flows are a bit different for this project. We have $70 million that we receive in year number 1, $50 million in year number 2, and $20 million in year number 3. When we look at the net cash flows, we have $100 million cash out, and we receive $140 million cash in. So the net cash flow from this project is only going to be $40 million. So if we look at it in very rough terms, it looks like Project L is a little bit better with $50 million in net cash flow versus Project S. However, the timing is going to be important. Remember, we have the same discount rate, and we're going to be discounting those cash flows just a little bit differently because of timing. And we'll come back to that in just a second. Essentially, when we value a project, when we value any project, we'd say the net present value of our project is going to be the sum of all of the cash flows received discounted at 1 plus the weighted average cost of capital, R, for each of the periods that we're considering. So if we have 3 periods for our cash flows, periods 1, 2, and 3, n would be equal to 3, and we'd say we'll start off from time equal to 0. So what is going to be the present value of those cash flows? Well, in our projects, typically, our first investment is going to happen in time 0 at the day that we start the project. So we could say, let's take the sum of all of the positive cash flows that we receive, periods 1, 2, and 3, and subtract from that the cash outflow, and the cash flow 0. And so that would be the formula that we're going to use to determine the value of our cash flows. So if we go back to Project L, the NPV of that project is going to be the minus 100 out, plus we're going to add in $10 million received in a year's time. 10 divided by 1.1 to the first power is worth $9,090,000. Period number 2, we're going to receive $60 million discounted by 1.1 squared is going to be worth $49.59 million today. And cash flow number 3, which is $80 million discounted by 1.1 to the third power, is worth $60 million in today's money. So the value of the project is going to equal minus 100 plus 9 plus 49 plus 60 for a total value of $18.79 million. That's going to be the value of our project. It's a positive NPV. Anytime the NPV of a project is greater than 0, or even equal to 0, we'd say that that project is providing us with a good rate of return. Any positive number. And that becomes our decision rule. We like 18.79, we would accept that project. If we did the same thing with project S, on the other hand, remember project S, it had the smaller net cash flow without discounting. Because the cash flows were received earlier, that $70 million received in the first year is discounted by a smaller amount. The NPV of project S is 19.98 million, doing the same kind of calculation. So what do we think of these two projects? Both have a positive NPV, so both are acceptable. If we're considering them independently, then we would accept both of them. If they were mutually exclusive, if we could only choose one of them, we like project S better because it gives us the highest NPV. And that's a decision rule. The decision rule means that as long as this condition is true, we would accept that particular project. And in this case, we like project S better. We can do this with our calculator, with the Hewlett-Packard calculator that we have, and Texas Instruments calculator that we have. And you'll see that in our calculator, we have got a number of dedicated buttons that are used for certain types of functions. Some of these you've seen before, but some of them you haven't. In this case, we need to use certain functions. The cash flow button on the second row, that's going to be something we need to use. And we're also going to use the NPV button, which is the button beside it. We're going to use the up and the down arrows to move between registers. We have to use the compute button, and we have pretty much those are all of the functions that we need in order to do these calculations. To enter the cash flows, we start off by pushing the cash flow button, and it says to us, it gives us the prompt, cash flow 0 is equal to how much? Well, in this case, it's 100. And we have to remember that it's a minus. So we've got the plus minus button in the bottom corner. We'll click on the minus and enter that. Now I click on enter, and now I have a triangle above the value, and that's been saved in a register. The next button I'm going to push is the down arrow, and that says take me down to the next register. And for cash flow number 1, my cash flow is 10, so I'm going to put in 10 and click on enter. I have to remember to click on enter or it won't be saved in the register. It asks me frequency. In this case, I'm only going to enter this number one time, so my frequency is equal to 1. That's the default, so I don't have to do anything at the F01 prompt. But for cash flow number 2, I enter 60 and enter. Down arrow, frequency of the second cash flow is 1 time only, so I'll leave that alone. Cash flow number 3 is 80. Enter. And that's pretty much it. So if I've got more numbers, I can enter more numbers until I've used up all of the registers. Now I want to solve for the net present value. And the net present value button is right there. So if I push it, it says, what's my interest rate, or what's the discount rate? And in percentages, my discount rate is 10%. So I'm going to click enter beside 10%. And if I push the down arrow, it'll prompt me. It'll say, what's the NPV? And I'll say, well, compute that. And it gives me 18.78. You can give that a try on your own calculator if you'd like, just to get a feeling for how that works. And if you've got any problems, well, just rewind and take a look at the example again. So that's the NPV calculation. We'll come back to the internal rate of return in a few minutes. Now, as well as using the calculator, we can also use an Excel spreadsheet to do the same type of calculations. Here's one that I made earlier. And you can see that my cash flows that I've entered for the years that we're considering, from say 2018 to 2021, if we made the investment in 2018 and that was a negative $100 million, and I made it red to represent the negative, I enter also my cash flows for year 1, 2, and 3. The calculation that I do to calculate the present value you'll see when I click on this, highlights the formula that I'm using. It says use B4. Now, B4 was the $10 million in the numerator, and in the denominator we'll have 1 plus $E $2. Now I'm using the dollar signs before the E and before the 2 to say use this as an absolute reference, so when I copy it down the column it doesn't change the value. You will always look in cell E2, and in this case that's going to be the percentage, and here I put 12%. So if I change that number, it will change it for all of the numbers in the calculation. For example, I want to use 10%, not 12%. So when I change that, you'll see that now I have exactly the same values I got with the calculator. 9.09 for the first year, 49.59, and 60.11 for the 3 cash inflows. Of course, I have no cash inflows in the later years, so those are just left blank. The calculation then of the present value, or the net present value of the project, is the present value of the cash flows net of the original investment. And that comes to, the sum of that column is just, well, 18.78. The sum of C3 to all of the values that follow afterwards. Now that's one way that I can do this calculation. The second way that I can do it with Excel is to use an NPV function. And that's where it says equals NPV. When I type in equal NPV, it prompts me, and you'll see down below I've got the prompt. It says NPV, and these are the values we expect to see. The discount rate, and then the string of the cash flows. And so in this case my discount rate was E2, and the values that follow are in B4 to B14. Now you'll notice that I left out the original investment, the original negative investment from cell B3. And that's because Excel is prone to errors if you do include a negative value at the beginning of the series of those cash flows. So I consider that separately, and since I don't need to discount that, that works just fine. So this is the alternative method. By having both methods, I'm double checking my work, and it makes it a little bit easier to see how this works. This spreadsheet, by the way, is available at the VIU Learn pages, or the content pages, for this week's session. The NPV method is essentially the method which equates the NPV of the project to the present value of the inflows less the cost. So whatever the cash inflows are going to be in present value terms, less the original cost of the project. It's the net gain in the wealth in dollar terms, and we accept the project as long as the NPV is greater than 0. In practical terms, you say that is true. In theoretical terms, you'd say you'd even accept the project if the NPV was exactly equal to 0, because that would mean that you're giving a fair return to the investors. If you have to choose between mutually exclusive projects, choose the one with the highest NPV. It's the one that creates the most value. If the NPV is greater than 0, that means that the incremental or the new projects are going to create a positive EVA for the company, and in the long term a positive market value added. So a company that's built up of positive NPV projects will be much more valuable. And our decision rule, in both cases, if they were mutually exclusive, we would only accept S, because NPV is greater than the NPV for project L. If they're independent, accept both of them because the NPV is significantly greater than 0. And that takes us on to the next stage.